on the US dollar, and it should have a dampening effect on higher bond yields. And I think you and I talked about this the last time we got together, that those were two major forces working against the commodity markets as we've come back from the WASDE report. And generally speaking, as we've come back from the Christmas and New Year holiday, the dollar is not breaking back for the price action after the holiday. We saw the dollar rally sharply. I think it again goes back to China, and it goes back to the US dollar being a safe haven in case we do have a deflationary pressure in China that's similar to what Japan experienced in the 90s. I think that's where the market is thinking this market's headed.
American export is struggling with China. Mike Zuzolo from Atchison, Kansas.
The biggest issue seems to me to be that because we can't find a bottom in Hong Kong, we can't find a bottom in Shanghai in the equity markets, that's an indication that the money's staying out of China, and therefore the Chinese currency hit an 8 to 9 week low in the offshore market against the US dollar. That spills over into currencies like the Brazilian real, which would hit a fresh 2 week low, almost a 3 week low against the US dollar, coming back from the
currency trading is lower for 8 weeks. From Michael's statement,
what I see happening next is if this dollar continues to be bought as a safe haven, we take out the report day lows from last Friday, which we did in wheat already. But if we do that in the corn and the beans, then technically speaking, and from the way these funds tend to trade, another 5 to 8% lower is what I'm suggesting to clients and subscribers as a possibility for where we're headed next as we get into February and that base price for the new crop corn and beans.
he suggests that the US dollar is a premium safe haven because we are fear of China's economy and definition for China. The audio by Chad Smith from National Farm Broadcasters Association in Platt, Missouri.